Moving on to Laura and cost segregation, I'm probably not the only one in the room, Laura, who would like you to explain cost segregation for us, and how it is an effective tax saving strategy.
Yeah, sure. So let's set the stage first. As we all know from our CCIM education, assets are depreciated over a long life. So 39 years for commercial properties and 27 and a half years for residential properties. And the IRS allows us to depreciate assets over shorter lives, depending upon the type of asset it is. So let me talk a little bit about cost segregation. So in a nutshell, it is a way to accelerate depreciation on a property or on a building so that you can lower your taxable obligation, your federal income taxes, and increase your cash flow. So what does that mean and how is that done? So property owners and tenants who have constructed, who have acquired or renovated property as far back as 1987 are eligible for cost segregation. It doesn't always make sense to go back to 87, but you're eligible, and I can kind of talk through how that works with each individual person. So let's talk about a cost segregation study. And the study is one where there's an engineer or somebody who's worked in the construction or real estate business, like an architect, who understands building, the building and the construction side of buildings. The engineer will go out to the property, do a visual inspection of that asset, and then start to reclassify the different elements of that building. They can reclassify them into different lives. 15-year land improvements, 5 and 7 years. And I'll talk a little bit about that and give you some examples, and I think the picture's up there, but I'll get to that. The other question I get asked a lot is when can a cost segregation study be performed? And the answer to that is ideally when you make the initial acquisition of that property, or you just finished constructing a new property, a new building. But also anytime you've had some major renovations, some major tenant capital improvements, tenant improvements, could be leasehold improvements. Anytime you've had a major renovation to a property, it's important to classify that component or that element of a building. Also, another time to do cost seg is when there's a change in ownership. So, for example, I've inherited a property, or there's a change in partnerships and the partnership interests. And keep in mind, there's two groups of people that can do cost segregation. One is the building owner, and the building owner either has to buy the building, they have to renovate the building, or they have to build it, okay? Or the tenant. And if I'm a tenant and I've spent the dollars to improve that space, that tenant is also eligible to accelerate that depreciation, okay? I get asked this question a lot. Well, Laura, I've already bought the building. I bought it 8 years ago. So did I miss my window? Did I miss my opportunity? And the answer is no, you have not missed your opportunity. There's the IRS allows us to go back as far as 1987 to do what's called a look-back study and catch up that depreciation in this current year of the study. And you can do that without having to amend tax returns. CPAs like that. It's by basically filing a 3115, which is a form that the CPA can file on behalf of the taxpayer for a change in the accounting method.
Laura, can you give us an idea of the magnitude of the tax savings that could be available for a couple of different property types, and also what the expense involved, in doing the study is?
You bet. It's about cost benefit. And before I do that, I got a picture on the wall, and that's a grocery store. And a picture tells 1,000 words. So what I wanted to show to you on this is this asset can be broken down. So think about when you buy a building, you've got to have a roof, you've got to have walls, you've got to have foundation, You have to have electric, you have to have plumbing. All of those are 39-year assets according to the IRS. But there are other components or other elements of a building that have shorter lives. For example, in this grocery store, you'll see lighting. If you look at the top, there's some fluorescent lighting, and then you look to the side of the fluorescent lighting, there's track lighting. In this example, that fluorescent lighting is core, it's primary to the building, it's necessary, therefore it's a 39-year asset. However, that track lighting is secondary lighting, and therefore it becomes reclassified into the 5-year life, along with not only the lighting, but the electrical elements associated with that lighting is also reclassified into the 5-year life. Another example is flooring. You look at the flooring on this picture, you've got vinyl flooring. Well, think about flooring you can have ceramic tile. In this room, we've got ceramic tile, we've got carpeting, and we probably have vinyl maybe somewhere. Ceramic tile is a 39-year asset. Carpeting and vinyl flooring are 5-year assets. So they get moved into that 5-year bucket. Go to the next slide. I'll talk about 15-year land improvements. This is just to give you an example. And then I'll talk about pricing in a moment, or benefits. Think about all of the things that are in a building or at a building when you drive up. You've got the parking lot, you've got curbing, you've got gutters, you've got signage, you have fencing, you have landscaping. You also have retention walls. All of that is a 15-year land improvement. It gets reclassified, okay? So it's the same amount of depreciation over the life of that asset. It's just a matter of when you take the depreciation. And so cost segregation allows you to, you do not increase the depreciation, you're just accelerating it. And think about what we've learned in the CCIM classes. It's the time value of money. You know, if I can get the pot of money now, it's worth more to me now than it is in the long term, okay? So that's what the concept is behind cost segregation, it's about the time value of money. So Bill asked about the magnitude of benefits. The next slide, if you can go to that, is a case study. I've got some of the, more than one in your packet. I'm just gonna go through one here. This is a new construction property. It is a kidney dialysis center in Alabama, and it's brand new construction. It's about 8,200 square feet, sits on 1 1/3 acres of land, and it was acquired for $3.8 million. And as we know from our CCIM days, land is not depreciable. So the actual cost basis of this asset is $2.35 million, and that's where we do the study on, is the value of that building and the improvements. At the end of the study, we were able to reclassify 32% into shorter lives, 5 and 15-year land improvements. And at the end of the day, what it means to that taxpayer is $166,000 in tax savings in that first year, okay? Over 5 years, net present value is a little over $200,000. So people often ask, well, what's this gonna cost me? And this is, that's a pretty decent benefit. Cost is not based on the value of the benefit that the taxpayer receives or the property owner receives. The value or the cost is associated to the amount of time it takes for the engineer to do the study. He or she needs to go out to the property, do the site visit, and then they need to come back and write the report based on what the tax laws are associated with that property type. And that ranges anywhere between $4,500 and sometimes $25,000. So it's a pretty big range. This particular property, this was a Fresenius dialysis clinic in Decatur, Alabama, and it was a $6,000 study. So they paid $6,000 to get $166,000 in that first year. Do we have?
Yeah, we had talked about this before, whether or not there's like a sales benefit, so to speak, with cost segregation. Is there a way to make the acquisition more attractive?
Yeah, so if you think about, how many of you attended the Atlanta Commercial Board of Realtors session? It was a couple weeks ago, and it was about the state of brokerage. It was really, really good. And basically the takeaway there was that brokers have to differentiate themselves by being consultative. And this is a strategy that can allow that broker to be consultative to their client. Because what you're trying to do at the end of the day is get a deal done, and the way you get a deal done is if you help them save, number one, save money, or number two, you help them increase cash flow. And that's what you can do here. And here's how I can help you, is if you tell me just a little bit about your property, I can run a benefits analysis, figure out what the potential savings would be, and then you as the brokers in the room, can use that to show the potential buyer, hey, if you did this, this is the potential savings you would have when you acquired that property. It's also true for on the tenant side, if you were to help a new tenant. But this is the potential savings that you could be entitled to as the buyer or the tenant of the property. I have one last slide, and this is, I just want to summarize with, we've been doing this since 2002, and we've done over 10,500 studies. We're a national company. Bedford Cost Segregation is across the country. I happen to be here in the regional office. But in our experience of doing those studies, the average results by property type is on the board here. So for example, if you're an apartment guy or gal, you can expect to see anywhere between 15 and 35% of that depreciation accelerated into shorter class lives. That's our experience. Well, let's say you're a shopping center. You have a shopping center, you're a shopping center broker or a shopping center owner. You can expect between 20 and 40% to get accelerated. Now, this is national averages based on doing 10,000 studies. The last thing I want to make sure we don't forget is the tenants. Tenant spaces, tenants also qualify for cost segregation because if the value or the benefits follow whoever spent the money. So if the landlord spent the money, the landlord gets the value or the benefit. If the tenant spent the money, the tenant gets the benefit. And oftentimes, tenants like dentists, medical, restaurants, they tend to invest in the assets and provide TI dollars. So just wanted to leave you with that. And really, at the end of the day, the savings is going to depend on the date the property was placed in service, the type of materials that were used to build the property, and the building itself, and then basically other facts and circumstances related to that taxpayer or that property owner and that property type.